This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 502 was produced on October 16th, 2025. I'm Eric Townsend. Variant Perception CEO Tian returns as this week's feature interview guest. We'll discuss the leading indicators Variant Perception uses to guide their macro strategy, what they say about growth and inflation, and how that translates to trades in today's market. And be sure to stay tuned for our post-game segment after the feature interview, because during that feature interview, Tian will explain why he sees a risk for a squeeze higher in the dollar index. Patrick will then translate that to specific actionable trading instructions in our new Trade of the Week segment right after the feature interview with Tian.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, October 15th, 2025. The S&P 500 index down 121 basis points, trading at 66.71. The trade war-driven volatility is back, but still has not cracked the market for a bigger correction. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index down 16 basis points, trading to 98.66. Consolidating the recent strength. The November WTI crude oil contract down 684 basis points, trading at 58.27. A decline is underway, begging the question if the April lows near 50 are in play for the next support line. The November RBOB gasoline down 681 basis points to 178. The December gold contract up 322 basis points to 42.01. Gold is in full parabolic mode right now. The December copper contract down 157 basis points, trading at 5.01. Uranium up 245 basis points, trading to 79.55. And the U.S. 10-year Treasury yield is down 11 basis points, trading at 4.02, trading near the lows of the year now. The key news to watch this week is Friday's monthly OPEX roll-off. And beyond that, we have the ongoing government shutdown and impacts on release of key economic data. This week's feature interview guest is Variant Perception CEO Tian. Eric and Tian discuss global economic outlook, inflation pressures, China, semiconductors, and more. Eric's interview with Tian is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Variant Perception CEO Tian. As usual, Tian provided not just one, but two slide decks to download in association with this week's podcast. Registered users will find the download links in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com, click the red button above Tian's picture that says Looking for the Downloads. Tian, it's great to have you back on. Before we get started, we should say probably that we are recording this on Tuesday morning, a couple of days before it will air. This is a week when quite a lot has happened since Friday. Needless to say, we're back to President Trump kind of throwing the market some unexpected tape bombs. What's your take on Friday's action, or what could happen between now and when this airs on Thursday? And after that, why don't we dive into your leading indicator watch, which is the first of your two slide decks?
Yeah, thanks, Eric. Great to be back. Obviously, there's a lot of uncertainty, but I think the biggest picture remains that the Chinese and the US are ultimately talking, right? So compared to when Trump first returned to office, compared to Liberation Day, I think there's a lot more established channels of communication. I think the Chinese response has actually been a lot more measured. That, the market's obviously a bit worried about the risk of escalation, but compared to 100% tariffs, like China's responded with very targeted measures. I wouldn't even be surprised if they maybe gave Trump a warning before they announced it. So overall, it kind of feels like there's a bit of posturing, ahead of the meeting. In the past kind of few weeks and months, you can see China kind of getting prepared for that, right? Strategically lowering their imports of like American agricultural products so they have something to give Trump for the meeting coming up. So I would say I'm heartened by how measured the Chinese have been in response to this. So that kind of suggests this isn't really the kind of tit for tat extreme escalation we saw back in April. This is ultimately, I think, going to be a bit more contained.
Well, I certainly hope that you are correct about that. Let's move into a whiff of reflation, which is the title of your G3 leading indicator watch this month.
In terms of the big picture, 6-month outlook, we essentially think this is a setup for a potentially reflationary environment. Our macro risk indicators have gone from, when we last spoke, a bit more neutral towards more kind of risk on territory in the last few months. Essentially, what we see right now is a synchronized global easing cycle amongst all the major central banks. Pretty good improving liquidity conditions, credit creation driven by the private sector. And our US growth LEIs have been pretty resilient all year, whilst we're starting to see kind of the first signs of Europe leading indicators recovering and China becoming less bad. So overall, that's a pretty decent macro setup. At the same time, we think the Fed cut in September potentially is a cut into a non-recessionary environment. So historically, there's been a couple of these examples in 84, 95, and you can also count the September 2024 cut last year. And the key takeaway is that the Fed cut ends up being an insurance cut, puts a bottom on the growth, and ultimately, growth and inflation hold up. And obviously that broadly leans into the idea that potentially yields and dollar kind of find a bottom and actually squeeze a bit higher. So that's kind of the biggest kind of 3 to 6 months ahead roadmap we have right now, and that's kind of broadly how we're thinking about it. I obviously understand concerns around AI bubbles and those things, but I would almost phrase it like there's a valuation problem in some pockets of the market maybe, but at least on our leading indicators, we don't think there's necessarily a huge macro problem right now.
Tian, let's dive into your leading indicators starting on page 3.
Like I mentioned, our main US growth LEI is still pretty stable at around 2% annualized growth rate. This is pretty much in the ballpark of where most high frequency coincident measures of US growth is. The Fed weekly, as we show here, annualized 2.3, 2.4%. If you strip out the volatile components of GDP now, you get at the core underlying private sector part, that's now at 2.5% annualized growth. And, other high frequency data like, TSA travel, restaurant booking, so forth, credit card spend, most things are fine right now. So, we will characterize as LEIs, lead indicators are resilient, and constant growth is also resilient.
You're describing an analog to 2002 through 2003 on page 4. What's the connection there?
Yeah, so I think one of the big outliers or points of concern right now is clearly the U.S. labor market. So there's a lot of concerns on, is the U.S. labor market weakness a sign of recession? Why is it that retail sales have held up and, the economy's held up, yet the job market is so weak? So we essentially had a look at when was the last time you had this kind of a setup. And so it's very interesting to note the last time we had hiring be this weak, but retail sales hold up and start to even accelerate was actually in the 2002, 2003 period, which was essentially characterized as a jobless economic recovery. And there's a lot of analogs. In addition to the retail sales divergence, you also had a similar kind of bottoming and acceleration in capital goods spending back then against the backdrop of weak hiring. So again, you can see the analogies to today with AI capex, but weak jobs. And the liquidity context is also very comparable. So again, you've got the weak labor market, but back then by 2002 and 2003, you have a pretty synchronized global easing cycle amongst the major central banks. You have the surge in global excess liquidity coming out a period of cheap energy prices, right? As we show here with the kind of drawdown in crude oil price as well. So all those things actually suggest this is more of a setup you see heading into a recovery rather than on the precipice of a recession. The major structural caveat is obviously to note that back then it was after China joining the WTO in 2001. So there was a pretty structural offshoring of US manufacturing jobs. And obviously that is something that it isn't going to be happening today, right? So ultimately, that kind of suggests there's less of a structural reason why the job market is going to remain weak like back then. There's some underlying signs for the US labor market that's decent. For example, prime age participation rate has recovered back to a pretty healthy level. So ultimately, we would think this is more likely a setup heading into a recovery. And if there's a recovery, eventually that will result in a turnaround in the labor market again, just like we saw in 0203.
I can't help but react to the headline on page 5. Recession is unlikely if everyone dissaves and financial conditions are loose. So as long as everybody spends beyond their means into easy money, everything's going to be fine.
Yeah, I mean, the way we think about recessions is ultimately these are like phase shifts, right? Where you go from a pretty normal cyclical behavior in the economy towards this sudden shift when the hard economic data and the soft kind of financial market data start deteriorating at the same time. The real reason to worry about recessions is those times when, financial assets start selling off, which then leads to kind of precautionary behavior. Households maybe save more, but as a result, earnings start falling, companies lay off more workers, and these vicious cycles are formed. And, I think that window of vulnerability was actually a bit more elevated if you think back to like May and June when equity markets had drawn down. There was a bit more signs of financial market stress. And obviously the economic data was kind of stalling. The difference today is that, some of the things we measure here, like real M1, the top left chart here, has returned to growth. So US real narrow money growth, real narrow money is growing. We obviously still have a pretty big absolute fiscal deficit. The US household savings rate had been rising, but it has started actually rolling over again. So again, households are continuing to keep a low savings rate. And obviously financial assets are still near all-time highs, right? Like, obviously it's been, a couple of days since the Trump tweet. So this is not to say that there's no risk per se. Our US recession model risk is around 30%, so low-ish, but not zero. The reason it's low is because of US housing and labor. But the key thing that would make it jump higher is that ultimately the time to worry is when, say, S&P draws down 5 to 10%, and then you get a bad job print, right? That's the time when these feedback loops could potentially start and both deteriorate at the same time. And it gets a lot more concerning about the phase shift to recession. As of right now, that isn't really the case. We can see how this kind of, China-US trade war escalation plays out. But I think that's the key point I want to make on this.
Tian, moving on to page 6, it looks like you're anticipating the potential for an inventory rebuilding cycle.
Yeah, so again, on that theme of are we more likely heading to a slowdown or recovery, there's some typical signs you actually see going into a recovery right now. So on the consumer side, one of the things we're showing here is that the bank's willingness to make consumer loans has actually been improving. And historically, this leads the U.S. kind of credit delinquency rates for consumers. So again, this will be a sign that delinquency rates have likely peaked in the U.S. Equally, if you look at U.S. discretionary retail sales, which we define as kind of those, big ticket items, furniture, home furnishing, electronics, clothing, and the like. Again, that's had a pretty torrid couple of years and been forming a base and has actually already returned to growth. So again, something you see more out of a slowdown than heading into one. On the wholesale side, if you look at durable goods wholesale revenues, that's actually started to accelerate even as inventory growth remains kind of tepid. So again, something you see more out of a slowdown than heading into one. And finally, within the ISM survey, there's this very interesting subcomponent called customer inventories. And that's something where, you can see the red line in the bottom right chart there. It's actually low and has been falling. So i.e., within the ISM survey, people reporting that their customers have low inventories and have falling inventories. So again, these are more signs of the potential for recovery than not. Overall, we get that the labor market looks a bit weak, but you're not getting that much confirmation elsewhere.
Moving on to page 7, let's take a look at inflation pressures.
Yeah, so I think the headline on inflation is that we are going to be above target for a while, but the risk of a second wave remains relatively low for now. And I think ultimately probably around 3% annualized inflation. In terms of the key data to keep an eye on, one thing we're tracking very closely is actually PPI and import prices, which is the top right chart here. So you can kind of see PPI for both goods and services are settling in at just below 3%. This is obviously a measure of how much pass-through pressure there will ultimately need to be on consumer prices. And equally, import prices are a reflection of are kind of foreign suppliers ultimately eating the tariffs, which the answer is no right now. So I think we're a little bit at the point where, yeah, there'll be some moderate pass-through pressure on the inflation front, but PPI is not surging. Factors like cheap energy prices and the like have likely helped there as well. And ultimately, what determines the ability to pass through price increases is actually lower income consumers, right? Which we know have been struggling a lot more. So the rate of pass through will tend to be more moderate. In general, you can think about the top 20% of consumers as driving growth, and the bottom 20% health as being important for how much inflation pass through there is. So right now, it kind of looks like there's some moderate, input cost pressures to pass through in general, but it'll be passed through at a more moderate rate.
Let's move on to China on page 8.
I think what's very interesting in China, the price action has obviously been pretty reflationary so far. We show here that Chinese small caps have been surging relative to large caps. Chinese 10-year yields have finally bottomed and started to tick up. And you're actually seeing the very first signs of things going from terrible to slightly less terrible. The bottom right chart there showing essentially an employment PMI survey for China, private sector one. And it has gone from kind of very depression-like levels and started to recover. So broadly speaking, we would say that China overall doesn't look as bad as it's been. And at the same time, lead indicators of both growth and inflation have bottomed and started to recover. So overall, we're heading into kind of the fourth plenum now. There's a lot more of talk about the Chinese authorities need to do some more for the consumption side. So yeah, I would say macro tailwinds are still there for China. And obviously, I'm making an assumption that Trump and Xi will ultimately meet and try and announce a win for each other. But within that context, the macro setup looks okay. Economy going from bad to slightly less bad. Liquidities, tailwinds are good, and asset prices broadly are on board with the kind of recovery story.
Let's move on to the Eurozone on page 10.
Yeah, on Euro specifically, what's very interesting is that Europe's structural problems are well known, right? From the political dysfunction to elevated energy prices, we show here on page 10, the bottom right. There's a lot of problems. But what's very interesting is that we're actually seeing a bit of a recovery in our lead indicators and some of the underlying data for the first time in a very long time. Essentially, over the past 3 to 4 years, you're really starting to see a more kind of coordinated recovery in the German data. So, for example, the German IFO expectations minus current conditions, that differential is actually turning positive now for the first time in a very long time. We see that in the top right chart there on slide 10. The percentage of German manufacturing industries where production expectations are improving, again, that's kind of recovered to more than half. So we potentially have a little bit of a cyclical rebound coming in Europe. Again, I think the structural problems are real, so the magnitude might not be there, but you're kind of finally seeing this come through, on the back of some of the excitement around German fiscal as well.
John, let's touch on slide 11. Consensus too optimistic on disinflation.
So on Europe, I think it's worth pointing out that the market, the ECB obviously was a bit further ahead of the US into getting their rate cuts in, and policy rates being taken down to 2%. I would say the consensus is fairly relaxed on European inflation risks, but it's interesting to note that our estimate of R star in Europe, i.e. the neutral policy rate, the real neutral policy rate is actually 0.8, which is a bit towards the higher end, I would say, of consensus of where ECB is. So that would actually suggest that the neutral nominal policy rate right now is more closer to like 3% rather than 2%. So we suspect that if anything, ECB policy is actually towards slightly more stimulatory territory. The market is obviously focused on the France risk right now. It's trying to price some cuts in, but if you look at the bulk of the Euribor curve, right, we got on the bottom right there. Ultimately there are now hikes discounted for 2026, 2027, and it's hard to price a lot more in for next year. So, given the ECB is ready to put the cuts in, given the very first signs of some of those cyclical lead indicator recoveries, the risk reward probably actually favors slightly more reflation in Europe and positioning for that.
Tian, I wanted to start there with the leading indicators because that's what Variant Perception is best known for. You also sent us a second PDF titled Macro Snapshot October 2nd. Tell us what that deck is about and go ahead and dive in.
Yeah, so that's kind of more the investment implications in terms of trade ideas or asset allocation. Obviously, using our lead indicators for kind of the 6 months forward macro context. So obviously, a lot of the elements we kind of already touched on. So maybe the key things I want to highlight here is if we go to like slide 6 and 7, that's probably the most important, and then we can talk about commodities as well. So I think right now, one of the concerns is that even if there isn't necessarily as obvious signs of macro problems, clearly there's some concerns around the lack of risk premium in asset classes, right? Whether you look at credit spreads or US large cap equities. So it's natural to be a bit concerned about have we fully discounted this relatively benign macro outlook. And, the way we think you can deal with it is that we have two very tangible signposts to watch for a sign that a correction may be playing out. And in fact, obviously, we put this out on October 2nd. We actually had a kind of hedging signal October 8th, which was fortuitous timing. But essentially, there's two things to think about. The first is, during periods like this, what we want to be very focused on is how cross-asset volatility and just credit and credit-linked are trading in general. Normally, when a correction potentially starts, what you observe is that all volatility across asset classes start to tick up from the lows, and all different measures of credit start to deteriorate. The key is the kind of breadth of it and the simultaneous nature of it rather than the magnitude. So if they're all deteriorating at the same time, that tends to be more reflective of the beginning of a broader de-risking. And so that's one of the key things to keep an eye on. And we're kind of starting to see kind of inklings of that a little bit. So that's just a very market behavioral stuff. We formalize it into the kind of VP correction signal. We have various versions of kind of tactical hedging signals right now. So it does make sense to keep some tactical hedges for the month of October. This is the bulk of earnings season. We have the Fed at the end of the month. And we also obviously have the Trump Xi meeting end of the month as well. So there's quite a lot of catalysts. That likely means that implied vol will remain bid. So you're a lot less likely to bleed as much as normal. So that's kind of the overall thinking there on the tactical piece of the portfolio. In terms of the cyclical roadmap and the signpost to watch for, one of the key worries right now is that the Fed cuts may become interpreted by the market as political, as reflecting Trump's desire for more cuts to lower interest expenses. And that works until it doesn't. We just don't know when. But the sign from the market will be that at one of these upcoming Fed cuts, it's possible we see the yield curve kind of have a sharp bear steepening in response to one of the cuts. And that would be, a market-based sign that, okay, we've kind of hit the limit here. And then, they probably need to pull back a little bit. So I think that's something I'm watching for very closely. I don't know when. I mean, it could be even the October Fed cut. The market has that reaction, but obviously it could be January or whenever it is. And I think that's just something to bear in mind, that I think we have this pretty decent macro Goldilocks setup until the Fed overdoes it and cuts too much, and then the inflation fears pick up, and then term premium, all these things matter again. So those are like the two tangible things right now to watch for.
Let's touch on semiconductors on page 7.
Yeah, so obviously, talk of the town AI bubble, right? Mental energy is being kind of spent on this already. So again, we're not going to pretend to be like the AI experts, but we do have some general frameworks we use to think about this. The key one being our capital cycle framework. And so ultimately on our capital cycle framework, what it tries to do is it tries to understand kind of CapEx and R&D spend, what the marginal operational ROIC is for that spend, and ultimately how that translates into profit. But we do it kind of across the entire aggregated profit pool. So what is more interesting to us is that on our capital cycle models is actually software that has been relatively weak within tech. Semis have actually seen improving capital cycle, while hardware has been kind of deteriorating slowly, but software is kind of the weakest. So despite all I think it's understandable a lot of the concerns around, .com repeat, dark fiber, or the rail build out, like a lot of those things are valid. But timing wise, typically the sequence we would expect to see is that, we need to see the marginal operational ROIC start to come off a bit. And then the capital cycle score will deteriorate a lot. So far, only one of the pieces are in place, which is essentially the surge in CapEx. But for a lot of the AI centric stuff, for the profit pool as a whole, the kind of marginal returns are still significantly higher than the weighted average cost of capital. Obviously, these things will shift as assumptions around useful life, depreciation schedules, vendor financing. All these things will eventually show up in how the weighted average cost of capital is calculated. But it's just worth highlighting at a high level that at least right now, the industry is covering the cost of capital. It's actually profitable, and so it may be a little bit early to be worrying about the surge in capex.
Let's touch on commodities on page 11.
Yeah, so I think the last thing that I think is very interesting is that we have a pretty unambiguously bullish commodity setup with our models as well. The demand, supply, and balance models are suggesting quite strongly for commodity recovery cyclically. And obviously, structurally, the backdrop should be pretty favorable, where we are moving to a world of kind of great power competition, right? Supply chains, commodities are being used and weaponized in geopolitics. And you have not just cyclical recovery, but also kind of more price insensitive, industrial policy driven or politically driven demand potential as well. So it's a pretty good setup for commodities. In general, now that gold prices in real terms have surged back towards kind of the 1970s, 1980s high, it's really about whether the other things can start to catch up, as we show on the top right hand chart here. So broadly, I think overall for the complex, we think the upside is still very, very good. The laggard's probably going to be oil this time, just because of OPEC and supply, and obviously some of the political imperatives around keeping inflation contained. But I think industrial commodities and the catch-up potential is very good, and ultimately, obviously, we'll get recovery in oil as well.
John, for the last few minutes, let's zoom out to this big picture that everybody's trying to figure out. Seems like just last Friday, China was absolutely evil and, was the end of the world. And then all of a sudden they're best friends again. Is this just a part of the Donald Trump approach to diplomacy? And what should we expect next?
So I think the biggest picture here is actually something we laid out all the way back in 2022 when we wrote a kind of pretty big thematic report on the coming capex super cycle, the end of the invisible hand, essentially the end of kind of free market driven, laissez-faire globalization, right? And I think this is kind of the biggest context for that. Basically, the US and the Chinese systems are moving from a focus on profit and efficiency towards the need for resilience. But, efficiency can, the flip side of resilience is essentially inefficiency, right? You're going to duplicate supply chains, you're going to stockpile more inventories, you're going to change how resources are allocated. And so I still think that's kind of what is really going on and having to manage that process. At the same time, there's, with the great power dynamics kicking in here, there's obviously a lot of lessons from history we can learn. So I think for me, a very useful context to think about is actually more the, US period would be kind of World War II into like the 50s with FDR and essentially the arsenal of democracy kind of analogy. So what that ultimately means is that when you have very important kind of national policy imperatives, you need to start thinking about the government's balance sheet and the private sector balance sheet as just one thing, one national balance sheet. So in FDR example I cited, that was like getting, the private sector to build your tanks and planes and to fuel the war effort, right? And then later on, coordinating between private and public sector in the Cold War. And this is essentially the playbook China has taken for quite a while, right? In terms of how China coordinates their private sector with government policy to drive a lot of, industrial policy imperatives, national policy imperatives. So I think that's kind of the biggest picture context, that we are just moving towards a world that, both countries want to emphasize resilience, supply chain resilience. And this idea of like, to compete, you kind of need to start coordinating a lot more in terms of big business, big government working together. And obviously, broadly speaking, like most of the marginal news we see, it leans into that story, right? All year long. So I think that's kind of where ultimately both sides want to end up. And then they just have to manage the transition in the middle, right? So, and this is where I think there's a realization that leverage is becoming, in my opinion, at least a bit more balanced. So I think the US probably does not have as strong a leverage as the US saw in terms of tech sanctions on China, right? The rapid pace of Chinese tech development, I think has probably surprised the US side. And equally, I think the US side might have underestimated the kind of short-term rare earth choke point. Again, in the long term, rare earth doesn't matter, right? Like, rare earths are not that rare. It's kind of abundant. You just have to be able to refine it. But in the short term, obviously, China has the refining capacity. And so they need to play that card while they can. So I would say that's kind of where, because the leverage is a bit more balanced, heading into kind of the Trump-Xi meeting, they can obviously try and position. But ultimately, I think, as I mentioned right at the beginning of this meeting, the structural direction is set, right? Both countries know they need to build up resilience from each other, and just to, prioritize domestic national needs. But they don't want to have such a dramatic kind of divorce that the short-term pain is too much. And so that's why all these communication channels are being established, since Liberation Day, and they're likely talking. And so I think you'll just keep getting these nominal wins that both sides can announce to their domestic audience, avoid the worst of the disruption. But ultimately, the trend is really towards, trying to build up essentially economic nationalism and resilience in terms of supply chains and manufacturing.
Tian, as always, I can't thank you enough for a terrific interview. Before I let you go, tell us a little bit more about the work that you do at Variant Perception. What services are on offer for our institutional investors, and where people can follow your work?
Yeah, well, thanks for having me on as usual. So, variantperception.com, we can share a link for some of your listeners as well if they're interested in getting some more materials or to have some access to our portal. But essentially, we focus on building investment models, right? Modeling the economy, modeling asset classes, modeling market behaviors, and modeling long-term structural capital cycles. And then from those models, we will find outliers or interesting investment themes, contextualize those in terms of the news and price action, and flag ideas.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Tian back on the show. Well, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Tian's picture saying, looking for the downloads.
Patrick, we're getting great feedback on our new Trade of the Week segment. What's on deck this week?
Eric, let's go a little deeper into the dollar story because this ties directly into what Tian discussed in the interview. He made a strong case for the U.S. resilience, sticky inflation, strong growth, and a Fed that's easing into strength rather than weakness, all of which sets the stage for a potential dollar squeeze higher. Now, what makes this setup particularly interesting right now is that the implied volatility on the euro futures has collapsed to year-to-date lows. I have a chart on page 2 showing this. We are currently around 6.6%, down from roughly 9% earlier this year. That tells us the market's completely priced for calm and stability. And when volatility is priced this cheap, the asymmetry shifts in our favor. Why? Because the carry cost of being long options is lower. The marginal vega risk to the downside is limited, and you retain the potential for a vega tailwind if a macro event forces risk premia back into the market. In other words, this is a perfect environment to own convexity. So rather than trying to express the dollar strength through a linear short on the Euro USD or an outright futures short, I'd rather do it in a convex way where my downside is fixed, but my upside is open if something breaks. Now here's the trade. Buy the March 6, 2026 Euro futures put option at the 1.1750 strike, which is essentially at the money for 198 pips. Which is essentially at the money for 198 pips, with the March 2026 Euro futures trading at 1.1745 at the time of this quote. In practical terms, that's 198 pips or $2,475 per contract, and it gives you the right to be short the euro at the 1.1750 over the next 5 months. you'll pay a small defined premium to own pure gamma, clean convex exposure in the market that's completely complacent on volatility. Those of you that want to visually see a breakdown of this trade, it is on page 3 of this week's Trade of the Week download. The beauty of this structure is that you don't need a crystal ball or a specific catalyst. Any macro event, a policy surprise, inflation shock, or geopolitical flare-up that pushes the dollar higher can create an outsides move relative to the premium at risk. For perspective, even a 50% retracement of this year's euro advance would take the pair back to around 112, where the option would be sitting on over 500 pips of intrinsic value. On the flip side, if the dollar bear market continues, your risk is clearly defined, you lose the premium and walk away. But the way I see it, you're paying a small insurance premium to own convexity on a currency market that is priced for perfection. And that's a trade I'll take every single time.
Patrick, that explanation worked for the pros, and of course our retail audience can get the full briefing by attending Patrick's Monday webinar, which always dissects the trade of the week in detail. MacroVoices listeners can get a free trial at bigpicturetrading.com.
Eric, let's dive into this. What's your thoughts here on the markets?
Well, Patrick, remember what I've said before, which is the Trump tariff turbulence that we went through several weeks ago was not going to be the last round. Needless to say, the next round is already upon us, and I don't think this next round will be the last round either. What happens next in the immediate term is going to depend on the headlines. Be ready to be whipsawed in either direction by Trump policy announcements. It's very clear that President Trump is not concerned about the short-term impacts on financial markets as a result of his strong policy choices. Moving back or stepping out to the bigger macro picture, I think where we are is in the misleading early phase of a secular inflation. Secular inflations always start out looking beautiful. It seems like everything's running hot, the economy is strong, everything's growing, it all looks great. It's actually just the beginning of the inflation, and the negative feedback loops haven't kicked in yet. So I think that's the big picture of what's happening for the economy. As far as what the market does next, it'll be headline driven. Let's see what Trump and Besant dish out next.
Well, Eric, we finally got ourselves a market correction. It was a very fast, rapid one-day peak to trough, 4% market drop that directly tested the 50-day moving average. So how do we size up the conditions of market? Well, first of all, we have the options expiration this week, which if the market stays within these major strikes, there's a lot of dealer pinning that happens just from the natural order flow of all that gamma that they have on the books. So the market consolidating here this week is not abnormal. But the big question here is that with this new rise of volatility, we're talking about a VIX that is now at 20 plus on the upside. At the same time, we have market breadth deteriorating, which I have on page 5. You can see that we hit a low of around 36% on the downside. We're bounced back to about 47%, but we have majority of stocks actually in a downtrend already selling. Now, what is a positive for the markets? Well, the bank earnings started to roll out and they all had positive reactions on it. I was looking at whether or not the financials would diverge and show that the deterioration, but they've at least shown a little bit of strength. Now, for me, this is a very simple trade. Right now, consider the bulls to be in control of this market above that 50-day moving average, with 6,600 sitting right at there and the low of the market coming around 6,600 from earlier in the week. This is a logical place to watch for a break. If we break down below there, we could see all sorts of systematic selling, whether vol targeting funds, CTAs, and even dealer gamma exposure that could start becoming a feedback mechanism that accelerates a downside air pocket. But right now, the market is not in that danger zone. So let's see whether that technical breakdown actually gets underway. So Eric, let's move on to the dollar. What are your thoughts?
Well, we tested the high end of the consolidation range. Haven't seen the breakout yet that Tian seems to be anticipating, and it's very much consistent with the tariff tantrum. We've seen this, bouncing up and down. Needless to say, what Trump just said was dollar bullish. That means we're going to test the high end of the consolidation range. We haven't broken out of it yet. I also want to comment that the strong rally in gold reminds us what's going on here with this U.S. dollar strength is relative to other currencies only. The big picture is fiat currency overall is debasing badly against hard assets. That's what's being reflected by the fact that gold is strong here, even in the face of short-term dollar strength. The next few policy headlines are going to determine what the Dixie does next as a relative strength indicator relative to other currencies. But again, dollar up, gold up at the same time is a very important reminder that the Dixie is a relative, not absolute measure, and the big trade here, the big picture trade, is dollar down or all fiat currencies down and hard assets, including gold, up.
Well, for me, the dollar is showing relative strength in the last few weeks. And this is an important thing to watch, whether it is bought on dip and whether we can stay above the 50-day moving average here. The entire US dollar bear market that happened this year has pretty much sustained below the 50-day moving average for pretty much almost 9 months. And so now with us pivoting here, will this be showing the price action that in fact the dollar has room to actually counter trend like we were talking about even through the interview? Now, for me, it's a lot about the different pairings. The euro broke down below the 50-day moving average. The pound sterling's been weak. That US dollar yen ripped to the upside after the elections. The US dollar CAD has broken out and remains at multi-month highs. So there's a backdrop that you can really see where US dollar strength can come from. So will we see some sort of a breakout here that really gets this underway, where we could see a dollar move up to 101 to even 103 on the upside? Certainly a really interesting moment in the dollar here. So let's move on to crude oil here. What do you make of this deterioration?
Well, we're just barely holding on to a 58 handle at recording time just before the markets open on Thursday morning. Whether or not that holds, I'm not sure. I think midterm to short term, Trump is going to win on his desire for lower oil prices. So I think we see lower before we see higher, but boy, higher is coming. Just give him time to start the next war or the next escalation in the one of the several wars that we have in different theaters. I'm sure high oil prices are coming back, but not quite yet. I think we've got a little bit of lower before we move higher. Needless to say, timing markets in the short term is dangerous work, so don't blame me if I got that one wrong.
Well, I want to refer back to Anas's interview when we had him on, in which he has a medium-term or interim outlook that is bullish on oil, but there's a lot of stress points on the short term. Clearly, they have emerged. And now with this technical breakdown of crude oil, I mean, we certainly can't even rule out a retest of those April and May lows that sit down in the low 50s. Now, can crude oil go down there? Of course it can. But the question is it going to be a major buying opportunity down there? And that's where I actually think we may want to visit that. On the short term, the risks are definitely a downside, but I think by November, if we're trading down there might be some asymmetric setups for trading oil to the upside. All right, Eric, what are your thoughts on this parabolic move on gold?
Well, this seemingly unstoppable rally, even in the face of a modest counter-trend rally in the Dixie, is nothing to celebrate, as I've said before. Yeah, it's good for gold investors in the short term, but really, gold is not a get-rich asset. It's a stay-rich asset. All it's doing is holding its purchasing power as fiat currency generally is collapsing in value, and that's the big picture of what's happening. I do think that this dollar rally can continue a whole lot higher. But wow, we're overdue for a meaningful correction. And to make no mistake, where this is headed is ultimately toward a blow-off top and a sharp, really heavy, painful reversal to the downside. Question is, does that happen out of 42.50 or 48.50 or 57.50 or 12,863? I don't know. We're going to go higher, higher, higher in this crazy euphoric stage of this bull market before it blows off. From what level it blows off, I have no idea, but I'm confident that's what's coming.
Well, the interesting thing about gold here, Eric, is that we are in the parabolic phase. When we blew through 4,000 like a hot knife through butter, that was a technical measured move. So whenever you see an acceleration beyond a measured move. I call those like the parabolic rises. And so when something goes parabolic, it is actually hard to call where the top will come in because it's just sure buying momentum. Arguably, we could see 4,500, even 4,700 with this kind of acceleration. But the one thing that is almost for sure is that when it runs out of steam, the correction will actually have the type of volatility it's having to the upside the other way on the downside. And so there's going to be a period where wherever we hit a short-term high, the pullback is now going to probably be bigger than 300 plus points that we were talking about in the weeks to come. But right now, you can't stand in this thing's way. This is pure momentum. We're going to find out where the short-term blow-off top will come in, but it certainly can still be at much higher prices. All right, Eric, let's talk uranium.
Well, the action is still in the miners, not so much on the spot price of uranium, and that makes sense. What we're seeing here is the speculators who know what's coming are looking for the leverage trades. That's why they're buying the miners first. But we need to see that spot price of uranium move for the sake of confirmation. If we don't, it's going to lead to some people saying, oh, wait a minute, it didn't happen like they expected, and that's going to be your trigger as soon as there's another catalyst in the market for a deep and painful correction. Frankly, I wouldn't mind that deep and painful correction. It's still a buying opportunity. I don't think that this uranium bull market is anywhere close to over. But boy, on a short-term basis, we're really overbought here. There's lots of room to see a correction before we move higher.
Well, Eric, there's some extraordinary momentum on those uranium stocks as we now see them finish all sorts of measured moves on the upside. To me, the asymmetry lies in trading uranium U308 to the upside. Now, I have that futures chart. You can see how it's gone through that 15-month bear market and has now merged the other side with old dips being bought. I love this setup on the chart. The way I look at it is I'd much rather be long now uranium, the yellow cake itself, and expecting some of these miners to have a breather here at some point after such an extraordinary bull run. Yeah, Eric, let's touch on copper.
I think we started from a place of having a really terrific bullish setup for copper from a macro standpoint. That has been interrupted once again by Trump tariff. Anything is possible in the short run. Who knows what headline is going to shock copper in one direction or the other next. If it's a shock lower, I say that's a buying opportunity because eventually this Trump tariff policy stuff will blow over and we're still going to have a strong bull fundamental argument for copper. But that fundamental bull argument won't become dominant until the policy stuff that Trump and Bessent are engaged in right now blows over. Let's see how long it takes for that to happen.
Well, Eric, copper continues to demonstrate accumulation, higher highs, higher lows, even the dips we saw here this week, quickly shooting right back up to the highs. Overall, copper has an upward trajectory, but we are reaching overhead resistance. Almost all the highs outside of the tariff pop all came in this kind of 510 to 550 area. Now, it doesn't mean we can't have another 25-cent surge higher, but we're going to start seeing copper here testing some key overhead resistance levels. We'll see if it puts a short-term lid on the upside of copper for the remainder of this year.
Patrick, before we wrap up this week's episode, let's hit that 10-year Treasury note chart.
Yeah, Eric, the 10-year Treasury yield continues to be one of the most interesting charts to me. If you observe here, we're trading at the year lows and it looks like on the verge of a breakdown. And this is the bigger question. Are we seeing a risk-off moment in the markets where the bonds are clearly advertising that a potential dollar rip and risk assets being sold? Is this the play? One way or another, this 4% level was the low back in March, April, and it's also, again, the low of August. So the fact that we're testing it, it makes it the thing to watch here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview. You'll also find the Trade of the Week chart book that we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we'll consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.